Okay, here today we have our discussion and lecture on global finance. And first, a couple terms. When we say that countries sell more than they buy, they're in a trade surplus. Conversely, if nations buy more than they sell, then they're in a trade deficit. Now, there are two different accounts that we're going to talk about. In the last lesson, we had talked about the current account, even though we didn't give it a name yet. But the current account records the transactions for all goods and services. The capital account deals with, as the name might imagine, capital flows. So the flows of money. Now remember, I usually, and I don't know if I've done this class, but I usually distinguish financial and economic capital. Because really, when an economist talks about capital, they're talking about the means to make money, right? Machines, tools, patents, processes, things like that. However, you need money usually to buy these pieces of capital. So a distinction I want to make, and the economic and financial capital do overlap, but I want you to think of the capital account as, yes, it's money flows, but the purpose of the money flows is to expand businesses. Now, there is a relationship between a trade surplus and being a net lender. Now, on the surface, this actually should be pretty intuitive, right? If you're a business or an individual and you're selling more than you're buying, then you have extra cash that you can invest in. Now, the real question is, if you're talking about countries and individuals within these countries that are buying and selling, do people tend to invest domestically or abroad? And there's a relationship here that if you're already investing in all the businesses, let's say we're talking about America, and you still have extra money because as a nation there's a trade surplus, so American businesses and business people tend to be selling more than they're buying. Well, if you've already invested in all of the American businesses, then the only thing that's left are to invest in foreign businesses. So we'll take a look at what that means. And this is a more formal way of writing out what you already know intuitively. Now, the purpose of math is not to make life more difficult. The purpose of math is actually to simplify life. So the point of me bringing math here to talk about this very simple idea is so that you can visually see how different variables relate to each other. So if we have this Y, which is national income or GDP or aggregate demand, right? All of these are synonymous for our sake. So if we have this national income equals consumption plus investment plus government spending, we can rewrite this to isolate for investment. Very simple algebra. So we have this expression. Now let's look at the left hand of the equation versus the right hand of the equation. The right hand of the equation, I'm looking at y minus c minus g equals I. The right hand is investment, and the left hand is, well, what is it? It's national income minus consumption minus government spending. Doesn't that sound like it's the savings rate? And actually it is. So savings should equal investment, or savings should equal business spending in a closed economy. If you can't borrow from anybody else, let's think about America now. Let's say America can't borrow or lend from other countries, then whatever we have left over after we spend money is going to be savings. Now, the savings should equal investment because whatever you have to save, you should invest in businesses. That is a simplifying assumption. Some people do decide to stuff their money under a mattress, but for the most part, we put our money somewhere which is converted into investment spending. Now, if we add international trade in the mix, well, we could do this other algebraic manipulation, y minus c minus g minus I equals nx. We can do that because it's just a simple identity. We're just solving for net exports. Now we have y minus c minus g minus I equals nx. If we replace y minus c minus g with savings, then we get this very beautiful equation, savings minus investment equals net exports. This is a beautiful expression because it tells us that there's a relationship now between whether you're a surplus or deficit trader and whether you're a surplus or deficit saver. Another way to interpret the left-hand side of the equation is that savings minus investment equals net capital outflow. If net capital outflow is positive, net exports is also positive. And now we've just proved mathematically what we already know intuitively, that if you sell more than you buy, as a nation, you're also lending more than you're borrowing. So a couple thoughts, a couple questions for thoughts, and we're not going to go through this right now, but it's something that I'd like you to reflect on. As a nation, do we want to sell more than we buy? Do we want investment leaving or coming into the country? Notice that if we want to borrow money, then we're going to need to run a deficit. If we like lending money, then we need to run a trade surplus. So which is better? That's I'm going to leave to you to reflect upon. And here we have a balance sheet. Now, this is just a visual representation for those visual learners. I'm not going to test you on this. This is not an accounting class. However, if you want to see a breakdown of current account, which is goods and services, versus the capital account, you may want to take a little bit of time to reflect, pause the video and reflect on this slide. Again, just for those of you that are curious. Now, what causes trade surpluses? There are three. First, having a comparative advantage. That's a big one. But the other major way is through currency depreciation. What this means is that as your goods and services get cheaper relative to other countries, foreigners may want to buy your products more. Hold on to the stocks. We'll get back to it. Now, okay, this slide is just a review, so I'm not going to go through this very quickly, but if net exports is greater than zero, we have a trade surplus. We talked about that, so let's move on. And now let's talk about the exchange rates, what they mean, and what they imply about whether a country can have a trade surplus or deficit. And lastly, how this impacts inflation and GDP. Do exchange rates impact inflation and GDP? Yes, they do. In fact, it's kind of a two-way relationship. So, do we want a strong currency or a weak currency? Instinctively, people may say they want a strong currency. But do we really? Let's think about what that actually means. First of all, an exchange rate, what it means is it establishes the relative strength of our currency. So many of you may have traveled abroad and you may get a quote. US dollar to euro, if it's 0.91, then that means that 0.91 euros will buy 1 US dollar. So the exchange rate is quoted one currency in terms of another currency. That's how much the other currency will buy one of the first currency. That's all that means. When a currency appreciates, it is harder to sell abroad, but it is easier to buy foreign goods. So if a currency gets stronger, we tend to have a growing GDP, a shrinking GDP. Don't be confused. A strong currency means a weaker GDP, but it also means lower inflation. The second point is important to remember, and it also should be fairly intuitive. If a currency gets stronger, we could buy more stuff, and so that's actually the opposite definition of inflation. The trade-off, though, is that because it's harder for domestic businesses to sell abroad, GDP will shrink. If we want to grow GDP but lower inflation, increase inflation. Wow, it is an off day for me. Don't mind me. Um, when a currency depreciates, GDP grows, but inflation also grows. So there's the trade-off. Do we want our economy to grow and not care about how expensive things get? Or do we want things to get more affordable, but we don't care if GDP shrinks? That's the trade-off. So here's a little recap. Since investment and net exports both form aggregate demand and exchange rates directly impact both, it follows that exchange rates impact the economy similar to fiscal and monetary policy. Actually, what we're going to see is that exchange rates have the same effect as interest rates. So exchange rates are going to be the opposite of inflation and GDP. And that's a very easy mnemonic for a quiz. If you want GDP to grow, interest rates should fall. Exchange rates should fall. If we want inflation to fall, exchange rates should grow. And this last slide is a recap. This is the monetary effects of foreign currency appreciation or depreciation. So this is a very important slide to look at for preparing for a quiz. And that wraps it up for global finance.